Let me first provide some table setting background. The economy and the capital markets are going through a major period of disruption, and our goal is to provide an array of sessions to help analyze the implications of that in several dimensions. Obviously, inflation has shot up, and the necessary reactions to that have upset the tenuous capital market balance that developed over the past several COVID-impacted years. The heavily expansionary period of both fiscal and monetary policy has now ended in a rather shockingly sudden way, with a major pullback in the level of available capital and an increase in interest rates. The heated US economy that brought an extremely low level of unemployment and extremely high levels of asset pricing seems over. What would this mean for retirement plan sponsors and individuals planning for their own retirements in this DC-dominated world? First of all, if we present session 209, Pension Investing in a Changing World. Here we'll address the investment policy approaches being taken by plan sponsors, which include an increasing emphasis on alternative asset classes as a way of expanding the range of risk-reward opportunities, as well as an ever-changing array of hedging strategies. Then, our next session is session 509, Whither Go Return Expectations. Here we'll talk about how in recent years the extremely low level of interest rates and historically high stock price multiples led to great current returns, but increased pessimism about the future return outlook. Now this new environment brings us something of a bad news is good news situation, in that the increased interest rates and declining stock multiples are leading to an increase in expected future returns. Models that struggle to substantiate a 5% portfolio return expectation for a typical pension portfolio over the next 10 years are now projecting 6% plus. Lastly, we have session 709, the macroeconomics of aging. This session will take us beyond the current fog of war and address the economic and capital market environments that lay beyond. The message here, unfortunately, is rather chastening. When the baby boomers entered the workforce 40 plus years ago, they started a period that can best be described as a demographic golden age. The number of workers was increasing far faster than the number of dependents at either end of the age spectrum. Dependent children on one end, and retirees supported by entitlement programs on the other end. The predominance of this middle demographic group, the working group, created a very beneficial environment for economic growth. And then as the boomers approached retirement, their level of savings shot up. What this resulted in was an inclination towards first strong growth and then abundant capital. But now we're in a transition to a much bleaker economic period as the favorable demographic tailwind evolves towards more of a demographic headwind. The dependency ratio is climbing and will only stabilize about a decade from now at a much more onerous level than pretty much ever before. That implies an immediate drag on the level of economic growth and a relative scarcity of capital as the new retirees start deaccumulating those retirement funds. Inflation will be a continuing problem in this new environment, given a rising imbalance between goods buyers and goods producers, which could essentially disable the expansionary monetary policy approaches we've come to rely on over the last several decades. This means that even if people are unhappy with the new economic reality, they won't be able to look to government to print or spend their way out of it. This may be reminiscent of a time over 200 years ago when Thomas Malthus described a more pessimistic economic scenario than this one, essentially mass starvation in that case, rather than just a slowdown in the growth of prosperity. That time, the world evolved in such a way that the dire outlook that he described never materialized. So to recognize the possibility that these presumptions about the future might not turn out as well, we'll also point out the adaptations that society could make that might act to mitigate the worst implications. So hopefully we piqued your interest engaging in one or more of these dialogues, and we'll see you in October.